Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the latest news updates pertaining to SoFi Technologies. SoFi Technologies is essentially a fintech company or a financial technology company that specializes in personal loans, mortgages, investment services, various types of banking, credit cards, debit cards, and insurance, which all fall under their portfolio. But where does this company make the most revenues? This company is essentially divided into three main segments. We have their lending segment, their technology platform segment, as well as their financial services segment. And currently, right now, over 70% of SoFi's overall revenues still come from their overall lending business. SoFi Technologies has been trying to branch out and achieve various other streams of revenue just in case anything happens to this main segment of their business, and as of late, they have been doing that very effectively. As of late, they've been growing their revenues at a very impressive clip at over 51.25% year over year on a percentage basis. However, as time goes on, they want to diversify their overall revenue streams to increase the amount of revenue that they are obtaining from their technology platform as well as their financial services platform, and this will make them more resilient in this overall economy. For instance, if we look at their financial services platform, it is growing rapidly. Currently, they're only bringing in around $49 million worth of revenue from this segment. However, it's growing on a year-over-year basis by around 287.9%, which is absolutely insane. If we compare that to their larger lending segment, that's only growing by around 37.82%, which is still very impressive because it's coming in over a 30% CAGR, but if we compare their lending segment to their technology platform or their financial services platform, clearly it's lagging behind. Their technology platform is growing at a 68.79% clip year over year, and it's bringing in $84.8 million worth of revenue. And as time goes on, SoFi wants to increase their overall exposure for their technology platform as well as their financial services platform, which is going to do the company a load of good. This will also push the company forward toward profitability, which will raise the overall share price. In the third quarter, around 80% of the money that was lent out from their lending segment was lent out in the form of personal loans rather than their main bread and butter, which would be mortgage loans as well as student loans. However, this makes perfect sense. For instance, the reason why the student loan revenue decreased was because of the student loan repayment moratorium being extended, so people aren't pressed to refinance their student loans right now, considering that they are not accruing interest and they don't have to pay on them right now. In a similar way, mortgage loans have also been lacking in this company during the short term because of various macroeconomic conditions, particularly rising interest rates to get inflation under control. But their personal loans have seen a radical increase in the overall lending segment, which would include personal, student, as well as mortgage. But why would personal loans increase? Well, it's actually quite straightforward. Due to the macroeconomic headwinds that we are experiencing right now, and for people finding it hard to pay on their various loans, instead of racking up credit card debt where their interest rates are rather high, instead they are doing something very smart and they are participating in a personal loan. So by getting a personal loan, they are paying off higher interest debt such as credit cards while the overall economy is suffering. So they are essentially lowering their overall interest rate by taking out a personal loan and paying off their credit cards, which is very, very smart to do. This is why their overall loan originations were still up by around 2% because we saw this radical increase in their overall personal loan business. Not only are they making the majority of their money over in their lending segment, but between the three main types of loans that are being given out in this particular segment, personal loans has more than made up for the lack of student loans as well as mortgages. So, how does this impact their overall share price? Well, clearly, if you look at their overall stock chart, we can see that the share price has trended down, but this is not due to anything intrinsically wrong with the business itself, but rather the overall macroeconomic environment. If you take a look at the stock market, the entire stock market is falling right now, which would include stocks like SoFi Technologies. So if the overall stock market is falling, the majority of stocks in the market are also falling, which includes SoFi. SoFi is not falling because there is something intrinsically wrong with the company itself, but rather it's a victim of the current macroeconomic factors and environment that we are in right now. And many investors are misunderstanding the reason why the share price is falling. Right now, SoFi is bunkering themselves down and using their time and resources to develop their overall businesses outside of its core lending operation, which is very smart to do right now. It plans to build new, highly profitable business segments despite the very competitive market that it's in right now. So although the share price is falling right now, and it could fall as low as $3.63 according to some professionals, make no mistake, SoFi remains extremely well positioned to take advantage of the overall market and their market share in the long term. And this will then reflect positively in the overall revenues as well as their overall earnings. A particular detail that I want to highlight, that in the short term, the company's share price will be quite volatile due to higher interest rates. Clearly, as interest rates rise, lending segments of various institutions, particular financial institutions, are going to suffer. So we're going to see a lower amount of overall demand for this particular type of service. And of course, the main reason for that is the world is toying and teeter-tottering on the edge of a potential recession, which many economists believe could take place in 2023 and 2024. But regardless if we enter into a full-on global recession or not, this company would still be a good buying opportunity, and here's why. Higher interest rates actually translate into higher profitability and more profitable margins for the loans that have been given out or will be given out. So even though the demands for loans will be lower, those loans on average are going to be substantially more profitable, thus allowing this financial institution to bring in more money. That's why during times of a recession, you can see a lot of technology growth stocks and even financial institutions lower in their overall share price, but this actually gives us a perfect investing opportunity because now their loans are even more profitable. And because SoFi Technologies relies heavily on their loan business segment, this is going to make them even more profitable as interest rates rise. But we do need to balance this with the potential for the people who are taking out the loans to default, because it's becoming more difficult for people to pay off these loans as interest rates rise. So clearly there is a risk to reward ratio here, but I would say it's more of a reward than risk if you are a long-term investor. Higher interest rates will also allow people to buy and take out more personal loans to pay off more higher interest rate debts like we were talking about earlier. People are actually doubling down and wanting personal loans so they can pay off higher interest rate debt like credit card debt. So this is providing a very unique macroeconomic environment for various financial institutions, which would include SoFi Technologies. Essentially, when analyzing this article, the bottom line is despite relatively poor performance in the overall economy, which is negatively impacting the share price in the overall stock market, dragging almost every stock down, on top of investors' fear of an overall recession, this is making it a good buying opportunity to buy lending businesses that are already well positioned for future growth. That's why the author highlights that this is arguably a great buying opportunity for long-term investors to take advantage of. And I actually agree with them. Now, with that being said, you don't want to over-allocate yourself to SoFi Technologies because it's a risky singular growth stock that isn't profitable yet. That's why I only have around a 4% allocation to this company. I'm not going to over-allocate myself right now because there are better companies to buy in the stock market that are much safer. And if you all know me, I like investing into ETFs, mutual funds, index funds, and blue chip large cap companies that also give me a dividend. But considering that SoFi is a very good company to bet on based off of their long-term fundamentals, I remain pretty bullish on this company, especially considering that now, technically SoFi could be considered now as a penny stock. But despite very long-term fundamentals intact and growing revenues like we saw earlier, on top of their ability to diversify themselves within the revenue segments, this is going to make the company very well prepared for future success. So this is a pretty exciting investment even based off of current levels, despite the overall bearish outlook on the economy. I would also like to add that SoFi Technologies is growing their overall member and product base at a very impressive growth rate, which just further shows us that they will continuously build their overall revenues and profits. and earnings per share to eventually achieve profitability toward the end of 2024. The last very bullish catalyst for this company, in my opinion, is how the director and CEO of SoFi Technologies has acquired around $7.4 million worth of SoFi stock within the last few months, which is very bullish because clearly this insider has insider information on the company, and he is so confident in the company's long-term fundamentals that he is buying up more right now. So this ultimately begs the question, is SoFi stock a good buying opportunity or is it a selling opportunity? Well, according to TipRanks, SoFi carries a moderate buy rating considering that professionals have 7 buy ratings and 4 hold recommendations on this company. I'd also like to highlight that they have no sell ratings according to the analysts that were surveyed by TipRanks. The highest price target we see is around $10 over the next 12 months, and the lowest one we see is $5. So even if the lowest price target is actually true, this company still has substantial upside because the company is currently trading for less than $5. But on average, professionals believe this company should be worth around $7.18, which implies around 55.75% upside, meaning that it's going to beat the overall market over the next 12 months, according to these projections. Considering SoFi's ongoing long-term momentum and their ability to increase their overall revenues in all 3 of their segments above a 30% CAGR, this company looks primed for future growth despite the current environment that we are in. Now, please be prepared. There are a lot of positive developments for this company, but in the short term, meaning over the next year or two, this company's share price is going to be very volatile. That means it's going to be surging and then dropping, and then surging and then dropping, probably being very volatile anywhere between $3 and $7. But once the company stabilizes after they become profitable by the end of 2024, according to current projections, this company is absolutely an amazing investment. But again, don't overexpose yourself. Another author highlights that it's no surprise why so many investors love SoFi stock. The company has been steadily growing over the long term, and their overall revenues are anticipated to continuously do that over the next half decade. The author also highlights that it's actually outpacing more mature, larger financial institutions such as Bank of America and Wells Fargo, which are not keeping up with SoFi's overall growth rate. Now, I think this is somewhat of a non sequitur because clearly SoFi is going to be able to increase their revenues more than Bank of America and Wells Fargo for 2 main reasons. Bank of America and Wells Fargo not only bring in more revenue, but their market caps are also a lot larger, which means, according to the law of large numbers, clearly SoFi is going to be able to scale their overall business segments much quicker than these larger financial institutions. But even with that being said, SoFi is growing so rapidly that eventually they will not only catch up to their stock price, but actually outpace it over the long term. SoFi's valuation right now is clearly lower than both Bank of America and Wells Fargo, which makes it an attractive buying opportunity considering that the company is so cheap, but could eventually turn into a company the size of Wells Fargo and Bank of America according to some professionals. However, that would take multiple decades to actually achieve. So if you're going to invest into this company, you have to be in it for the long term. In the short term, particularly throughout 2023, interest rates could drive stocks even lower, and it could negatively impact their overall lending segment. But as they diversify in various revenue streams, and considering that higher interest rates could lead to higher profitability on their loans, this could ultimately be a good thing as long as it's not drawn out for the next 3 years. If this is in the short term and it's only lasting 1 to 2 years, this company could be a great buying opportunity. And eventually, interest rates will eventually come back down, the economy is going to stabilize, and the student loan moratorium will end. That provides SoFi Technologies in particular 3 very large catalysts that are going to happen over the next 1 to 2 years on top of the company becoming profitable. So technically, there is going to be 4 very positive developments for this company in the short term. So if you're willing to ride the roller coaster of SoFi Technologies, always make sure to do your own research, make sure you're not overexposed to this company, double check to make sure your portfolio has a strong core of solid long-term ETFs, index funds, mutual funds, or blue chip companies that are going to keep your portfolio above water in the short term. And that is today's news update on SoFi Technologies. So I would love to hear your thoughts down below. Remember to go and smash that like button right now, subscribe if you are new, and I will see you in the next YT video.